After studying this module, you shall be able to know the traditional methods of estimating working capital, analyze the operating cycle method of estimating working capital, understand the most appropriate method of determining working capital. In this module, we will discuss some methods of estimating working capital needs of the firm. The most appropriate method of estimating working capital needs of the firm is operating cycle, which we have discussed in the last chapter. However, there are some other methods as well for estimating the working capital needs of the firm. First of all, we shall discuss other three methods of estimating working capital. Then we will discuss how operating cycle concept for estimating the working capital is being used by the firms. Let us look at the traditional methods of estimating working capital. There are three approaches for estimating the working capital needs of the firm, which have been successfully applied in practice. The first one is current assets holding method. The first one is current asset holding period. This method is based on the operating cycle concept of working capital. A firm uses this method to estimate working capital requirements on the basis of average holding period of current assets and relating them to costs based on the past experience of the company. The second one is ratio of sales, which is based on the past experience. Some average percentage of sales may be taken for determining the quantum of working capital on the assumption that current assets change with sales. The third one is ratio of fixed investment, which is working capital may be determined as a percentage of fixed investment also. For illustrating the above methods of estimating working capital, we shall take the example of two hypothetical firms in the following table. The table shows firm A and firm B with the separate material costs and with net material cost, with the manufacturing cost, the labor maintenance cost and power fuel and the depreciation. The factory overhead costs are also given. The total cost of production for A and B is 9,92,000 and 11,92,000. You can also calculate the investment and the plant life and the EBITDA as shown. The assumptions are: method 1, inventory is 1 month supply of each raw material, work in progress and finished goods. Debtors 1 month sales, cash 1 month's total cost. Method 2 is 20 to 30% of annual sales. Method 3 is 15 to 25% of fixed investment. The following calculation shows that the three methods work for firm A. You may calculate for firm B also. After calculating the inventory requirements, the projection for debtors and cash should be made. We shall also see what is the impact of different approaches on return on investment. The first method gives detail of current asset items of working capital. This method is not appropriate if markets are seasonal. As per this method, required working capital for firm A is rupees 3,54,751 rupees. If this amount is used in calculating the return on investment, it is reduced from 33.3% to 27.84%. The rate of return is calculated as follows. The rate of return is EBIT, that is earnings before interest and tax payment, divided by net fixed investment plus working capital. The second method is not much reliable. Its accuracy depends upon the accuracy of sale. The rate of return is reduced to 27.3% under this method. The third method shows the relationship of working capital with investment, and the accuracy of this method depends upon the investment. The rate of return is reduced to 27.27% under this method. Now we shall understand the operating cycle method of estimating working capital. The working capital estimated as per this method is the most systematic and logical approach. In this method, estimation of working capital is made on the basis of each and every component of working capital individually. As explained earlier, the working capital required to sustain the level of planned operations is estimated by calculating each and every component of current asset and current liabilities. The calculation of net working capital NWC may be shown as working capital is equal to current assets minus current liabilities. Current assets include stock of raw materials, stock of work in progress, stock of finished goods, debtors and cash balance. Current liabilities include creditors, outstanding wages and outstanding overheads, where raw material stock is equal to average cost of materials in stock. Work in progress stock equal to cost of materials plus wages plus overhead of work in progress. Finished goods stock is equal to cost of materials plus wage plus overhead of work in progress. Creditors for material is equal to cost of average outstanding creditors. Creditors for wages is equal to average wage outstanding. Creditors for overhead is equal to average overhead outstanding. While determining the working capital requirement, following points should be given due consideration. The first one is depreciation. Depreciation on fixed assets is an important point that needs to be considered in the estimation of working capital requirement. The depreciation on fixed assets which are used in the production process or other activities is not considered in estimation of working capital. The depreciation is a non-cash expense and there are no funds blocked in depreciation as such, and therefore it is ignored in the valuation of work in progress or in the valuation of finished goods. If working capital is estimated by including the amount of depreciation, such estimate is known as total basis working capital. If working capital is estimated by ignoring depreciation, then such estimate is known as cash basis working capital. The next one is safety margin. Sometimes a firm may also like to have a safety margin of working capital in order to meet any contingency. It may be expressed in terms of percentage of total current assets or total current liabilities or NWC. It is incorporated in the working capital estimates to calculate the NWC. There is no hard and fast rule for quantum of margin of safety and depends upon the nature and characteristic of the firm as well as of its current assets and current liabilities. Let us look into the practical problem in estimation of working capital. The cost sheet of ABC Limited provide the following data: the raw materials, the direct labor, the overhead cost, the total cost, the profit, the selling price. Average raw material in stock is for 1 month. Average materials in work in progress are for half month. Credit allowed by suppliers 1 month. Credit allowed to debtors is 1 month. Average time lag in payment of wages is 10 days. Average time lag in payment of overheads is 30 days. 25% of the sales are on cash basis. Cash balance is expected to be rupees 1 lakh. Finished goods lie in the warehouse for 1 month. You are required to prepare a statement of the working capital needed to finance a level of the activity of 54,000 units of output. Production is carried on evenly throughout the year and wages and overheads occur similarly. State your assumption, if any, clearly. The solution for this is, as the annual level of activity is given at 54,000 units, it means that the monthly turnover would be rupees 54,000 divided by 12, which is equal to 4,500 units. The working capital requirement for this monthly turnover can now be estimated as follows. In this, we have to calculate the current assets given by the minimum cash balance, the inventories, the raw material, work in progress, and the finished goods and the debtors. The gross working capital is 12,81,250. Next, we have to calculate the current liabilities, in which the creditors for materials, the creditors for wages, the creditors for overheads give us total current liabilities. The net working capital comes out to be 8,91,250 rupees. There are some working notes for this. The overhead of rupees 40 per unit include a depreciation of rupees 10 per unit, which is a non-cash item. This depreciation cost has been ignored for valuation of work in progress, finished goods and debtors. The overhead cost therefore has been taken only at rupees 30 per unit. In the calculation of work in progress, the raw materials have been taken at full requirement for 15 days, but the wages and the overheads have been taken only at 50% on the assumption that on an average all units in work in progress are 50% complete. Since the wages are paid with a time lag of 10 days, the working capital provided by wages has been taken by dividing the monthly wages by 3, assuming a month to consist of 30 days. The next illustration. PQR Limited is presently operating at 60% capacity level, producing 36,000 units per annum. In view of favorable market conditions, it has been decided that from 1st January 2000, the company would operate at 90% capacity. The following information is available to us, in which the existing cost price structure per unit is given, which includes the raw materials, the wages, the overhead which is variable, the overhead which is fixed, and the total profit. It is expected that the cost of raw material, wages, other expenses and sales per unit will remain unchanged in the year 2000. Raw materials remain in store for 2 months before these are issued to production. These units remain in production process for 1 month. The finished goods remain in go down for 2 months. Credit allowed to debtors is 2 months. Credit allowed by creditors is 3 months. Lag in wages and overhead payments is 1 month. It may be assumed that wages and overhead occur evenly throughout the production cycle. You are required to prepare profit statement at 90% capacity level and calculate the working capital requirements on an estimated basis to sustain the increased production level. The assumption made, if any, should be clearly indicated. The solution for this is the statement of profitability at 90% capacity. The number of units to be taken is at 90% capacity. The sales will give the equal amount accordingly. The cost of raw materials need to be calculated again for this 90% capacity. The wages, the variable overheads, the fixed overheads will give us the total cost, which is 4,68,000. The net profit would be 72,000 rupees. The statement of working capital requirement would include the particulars like stock of raw materials, work in progress, material, wages, overheads, finished goods, debtors. These all form the current assets, which give us the gross working capital. The current liabilities include the sundry creditors, outstanding wages, outstanding overheads, total liabilities. This all would give us the net working capital. There are some working notes for this also. The work in progress period is 1 month, so the overheads included in work in progress are on an average for a half month, because overheads have been taken only at 50% on the assumption that on an average all units in work in progress are 50% complete. The overheads are given by 50% of 4,500 units into rupees 2 into 1 month plus 50% of 36,000 divided by 12, which gives us rupees 6,000. The valuation of finished goods can be arrived at as follows. The finished goods can be given as 4,500 into 8 into 2 months plus 36,000 divided by 12 into 2 months, which is rupees 78,000. Since the overheads are paid to creditors with a time lag of 1 month, so evaluation of outstanding overheads can be done in the following way. The outstanding overheads are given as 4,500 into rupees 2 into 1 month plus 36,000 divided by 12 into 1 month, which gives us 12,000. Moving further, we have to see one more illustration. XYZ Limited sells goods on a gross profit of 25%. Depreciation is considered as part of cost of production. The following gives us the annual figures of sales, the material consumed in 1 month, the wages paid in 1 month, the cash manufacturing expenses, the administrative expenses and the sales promotion expenses, which have different timelines. The company keeps 1 month stock each of raw materials and finished goods. It also keeps rupees 1 lakh in cash. You are required to estimate the working capital requirements of the company on cash cost basis, assuming 15% safety margin. The solution for this can be started by preparing the statement of working capital requirements, which include the current assets, namely the minimum cash balance, the debtors, the prepaid sales promotion expenses, also the inventories, namely raw materials and the finished goods. This gives us the total current assets at 5,05,000. The current liabilities include the sundry creditors, the outstanding manufacturing expenses, outstanding administrative expenses and the outstanding wages. This gives us the total liabilities at 1,17,500. The excess of current assets and current liabilities come out to be 3,87,500. We need to add 15% for contingencies, which is 58,125. The net working capital is now 4,45,625. For this also we have some working notes. we need to calculate the cost structure, which includes the sales less gross profit, then the cost of production, the cost of materials, wages, cash manufacturing expenses and the depreciation. The total cash cost needs to be calculated also, the cost of production less depreciation. Then we have to add the administrative expenses and we need to add also the sales promotion expenses. The total cash cost is given by 14,70,000. Moving further, we have to look into one more illustration. Gulfarm Limited is presently operating on single shift basis and has the following cost structure per unit. Selling price is Rs 36, the raw materials of Rs 12, wages 60% variable at Rs 10, overheads at 20% variable at Rs 10. For the year ending March 31, 2000, the sales amounted to Rs 8,64,000 and the current asset position on that day was as follows: the raw materials, the finished goods, the work in progress and the debtors. At present, the company receives a credit of 2 months from the supplier of raw materials, and wages and expenses are payable with a time lag of half a month. In order to meet the excess demand, the company is preparing to work in double shift. The increased production will enable the firm to get a 10% discount from the supplier of raw materials. There will not be of any change in the fixed cost, credit policy, etc. Ascertain the effect on requirement for working capital if the proposal of double shift materializes. The solution for this is, in order to calculate the working capital requirement for double shift operations, the existing parameters should be ascertained as follows: the present position of sales, debtors, raw materials, work in progress, finished goods and new cost of raw material. The statement of working capital requirement can be prepared as the current assets, which include the raw materials, the work in progress, the finished goods, the debtors, and the total current asset come out to be 4,52,000 rupees. The current liabilities include the creditors, wages and overheads, total current liabilities, which gives us the net working capital at 3,84,000 rupees. The statement of working capital for the proposed situation would be current assets that include raw material, work in progress, finished goods and debtors, and the total current assets come out to be 8,59,600. The current liabilities include the creditors, the wages and overheads, and the total current liabilities come out to be 1,26,400. The net working capital is now given by 7,33,200. Therefore, working capital requirement will increase by Rs 7,33,200 minus Rs 3,84,000, which comes out to be Rs 3,49,200 due to change from single shift to double shift operations. Let us summarize our discussion so far. The most appropriate method of determining working capital needs of a firm is operating cycle. However, there are some other methods as well for estimating the working capital needs of the firm. Apart from operating cycle method, there are other three methods, namely current assets, holding period, ratio of sales and ratio of fixed investment. In the operating cycle method, working capital is calculated as the difference between current assets and current liabilities. If depreciation is included in the cost, then such estimate is known as total basis working capital. If depreciation is excluded from cost, then such estimate is known as cash basis working capital.